interest rates are to stock prices what gravity is to matter. I mean, if interest rates were nothing, and they were going to be nothing forever, you'd be buying stuff that would yield you 1% or 2%. You might be buying real estate, you might be buying stocks.
So continuing on with your investment philosophy, let's talk about IBM for a moment.
Yeah.
And you've said that it was a mistake, and we all make mistakes.
It was my mistake.
I make my fair share. But let's go over what you learned from that mistake. I mean, you, as I say, generally you find business you believe in over the long term and management you believe in. What went wrong?
Well, I've made lots of mistakes, Dave. That's part of the game. I mean, there is no way in the investment business, if somebody says to you they never made a mistake, check them out. But that was a fairly large commitment. And I would say that the competition, what's really fascinating to me actually is what Amazon did with the cloud. I mean, here is a company that you don't even think of as being in that business 6 or 7 years ago. And Jeff Bezos has really taken something, like, you wouldn't have thought they'd be doing that. And from a standing start, and he has even said on Charlie Rose, he was amazed at how much runway he was given. But here are a bunch of very smart people in the tech industry around him, and not just IBM, but Microsoft, Google, you name it. I mean, the people. And they let all of them have a big lead, and you don't want to let a smart fellow have a big lead.
But what does that tell you about the tech sector in general when it comes to investing? Because it seems that tech may be more susceptible to massive disruption than other run-of-the-mill businesses.
Sure. I mean, we've got a railroad, and we're not going to wake up tomorrow and find 4 new railroads are competing with us or something of the sort. And in the tech business, you have a group of very smart people who have access to resources, and they're all the time trying to figure out how to bring out a better product than you have. I mean, here, I may be carrying this around, but this was the hottest item around, I'm sure, at one time. But
well, you've got a big investment in Apple. They're coming out with a new iPhone. You might want to think about it this fall.
Yeah, well, Tim Cook's reminded me of that a few times.
So talk about your investment at this point. You have, last time I checked, something close to $100 billion of cash and cash equivalents waiting to be invested.
Yeah.
You might not want to invest all of that, but you'd like to invest a fair chunk of it.
I'd like to invest all but $20 billion. I always like to keep $20 billion around.
What does it tell us that Warren Buffett, Charlie Munger, and Berkshire Hathaway can't find sensible investments to make in this climate of that $80 billion?
It tells us the stocks aren't as cheap as they've been most of the time. It was shooting fish in a barrel in late 2008 and 2009, and stocks have been steadily going up, pretty steadily going up now for. March of 2009 was the low, early in March. So it's 8+ years, and stocks aren't going to earn much more. They're not going to earn more just because you pay more for them. So they have gotten less attractive as they've gone along. They're still very attractive compared to bonds. I mean, if you look at the 10-year government at 2.15, that means you're paying 45 times earnings when you buy that bond. And the earnings aren't going to go up. I mean, if you put $100,000 in that 10-year bond, you're paying 45 times earnings for a form of investment where the earnings can't go up. Well, stocks still look attractive compared to that, but they don't look as attractive nearly as much as they used to. And of course, if interest rates go up, then the comparison becomes far less dramatic.
Well, and I wonder if there isn't a direct connection between those two things.
Oh, there is a connection.
And how much of it is because the central banks, not just the Fed, but also the ECB and the BOJ, particularly the Bank of Japan, have really injected trillions of dollars and euros and yen into the system, which has driven asset prices up.
It drives them up. There's no question. They probably wanted to drive them up too. But the interest rates are to stock prices what gravity is to matter. I mean, if interest rates were nothing, and they were going to be nothing forever, you'd be buying stuff that would yield you 1% or 2%. You might be buying real estate, you might be buying stocks. If interest rates are, on the short rate, 21% like they were in 1982 under Volcker, you could look at a stock at 6 times earnings and you could say, well, that's really isn't that attractive. So interest rates, I mean, that's what drives valuations, and we've had these very, very low interest rates now for sometime a lot longer than I thought we would have them, and probably a lot longer than most people thought we'd have them.
And at the same time, we have the Federal Reserve certainly signaling they're going to start coming off. They're going to start letting that balance sheet roll off some. We have even the ECB saying maybe they'll cut back on quantitative easing. What effect might that have on stock prices and other asset valuations?
Well, I think they'll be pretty careful about how they do it. The Federal Reserve has about $4.5 trillion in assets now, and it's as I remember, it's $1.7 trillion or 8 in mortgages and the balance in U.S. governments, and they can just let it. They can do it by maturity, but if they were to go back to the trillion or $1.5 trillion, that would be $3 trillion of maturing securities that they would not be taking up their piece on, and somebody else would have to do it. So they'll be very careful about how they do it.
So has quantitative easing worked? I mean, certainly it saved us. At the same time, it seems like there was sort of a trickle-down theory that if we increased asset prices and income to people making money off of assets, that somehow it would get the economy going, and yet the average hourly wage is not going up as fast.
No, but it did wonders for us coming out of 2008. Not without it, if we'd gone back to the economics of 100 years ago, and the Fed had not been there to ease, and we'd have had a far different recovery. No, I think the Fed has overwhelmingly done the right thing. Now, we've never gone through a period like this, and how it will all work out, we will find out. I think they'll be intelligent about it, but they've never played this game yet either.
So one issue is the tricky transition, which, as you say, we've never seen before. And this kind of massive monetary easing.
Yeah.
At the same time, there's a question of whether monetary policy needs to hand off to fiscal policy. And when Donald Trump was elected president, there was a lot of hopes about tax reform, about infrastructure spending. How critical is that to really robust growth in the underlying economy?
I think our economy will grow. What really drives the economy is the market system, and it's the people like the Jeff Bezoses of the world, and we haven't had good productivity gains lately. But if productivity per capita goes up, the country's wealthier. I mean, it's that simple. So productivity gains and innovation are the key, and they largely will come from the private sector. And the private sector is plenty incentivized to do that sort of thing now, and they've got the resources.
So and typically productivity is tied to capital investment in innovation.
Yeah. Although it's this phone is pulled out. That's a form of productivity, and that can be R&D and all that, but it isn't big steel mills or big oil refineries. I mean, wealth 100 years ago with the Rockefellers and the Carnegies, it involved huge capital investment. If you take the 5 largest companies in market cap in the S&P now, they're 10% of the overall S&P. They're all tech companies. You could run all 5 of those companies with no equity capital. So you've got 10% of the S&P with the 5 companies that are making our lives better, but they don't require any equity capital.
Does that suggest maybe we're measuring productivity the wrong way around? Because when we started the measurement, we didn't have things like that little cell phone in your pocket.
Well, that's always a question. I mean, the fact that I can write my annual report a lot easier now, because if I want to check a quotation or a fact, it takes me 15 seconds on search, whereas I used to have to go to a library or right away for, that's made me enormously more productive. Not that anybody necessarily wants the product, but I can get things done a lot faster. Does that get into the GDP figures? I'm not sure. I mean, I suppose some economists would say they've really got a way of correcting for all that, but I really think that there have been a lot of improvements in lives. I can play a bridge game now, by getting 3 people together on the internet in 15 seconds or 30 seconds. I used to have to make calls and get my buddies to drive over and all kinds of things. So our lives have gotten a lot better in general than actually I think the GDP figures show.
Well, it's interesting you say that. You've said, I've heard you say before, that if you're born in the United States today, you've won the lottery right there.
Absolutely.
Right there. At the same time, as you look around the country, there seem to be a lot of people who don't believe that, who don't feel that they're participating in it, and they're angry, and they're hurt, and they're scared. Why is that?
And I don't blame them. I don't blame them, because they see the Forbes 400 that had 92 billion of aggregate wealth in 1982 that now have 2.4 trillion. So they've seen that top 400. It's a changing group, but it represents the people at the top. They've seen them go up 25 for 1 in wealth since 1982. And you can see it in the income tax figures and a whole bunch of places. So the gain in wealth in this country has disproportionately gone to the super rich, and a lot of people have gotten left behind, which should not be the case in a country that, our country has $57,000 or $58,000 of GDP per capita. You know, that is a lot of money per capita, but the distribution has gotten more pushed toward the top in recent decades. It's not because those people are evil, it's just because of the natural function of the marketplace, but it's up to the government actually to do something about that.